Hey everybody, hope everyone is doing well and had a good Monday. So let's start with the daily chart. On the daily chart, you can see we tested near these 2023 highs, and you can also say this is really just 4,300. And I've really got this written here just more as a reminder that we hesitated a lot in here. And the top of the trading range could be this high, it could be this high right here. But in any regard, there's support somewhere in here. We're also hesitating and stalling right at the 200-day moving average. So probably, what do I expect is going to happen this week? I think we're in a trading range. And for the bulls, I don't think we're not going to reverse into a bull trend, and we might, but I doubt it. I think more likely the market is going to go mostly sideways here. Now, sideways could be all the way up to the moving average. It could be 4,400. We have the August 18 low, which is a pretty important magnet right here. So tomorrow, the bulls, they want a double bottom and an upside breakout and a test of 4,400. The bears, they obviously want to stop the bulls. But in any regard, if we do rally, it probably will not be very strong. It'll probably be weak. And the bulls, they want something strong. So they want a strong bull breakout or a gap up with follow through, testing 4,400. There are bulls who bought the 4,400 and more lower. And because of that, it's reasonable to assume that we're going to have to test this price level. Weekly chart last week was it was a bear bar, but it was disappointing bear bar. And we have a bear breakout here, but it's not clearly a bear trend. It's just a bear breakout. And what traders don't know is this some kind of second leg trap? Give me 1 second. Is this going to be a second leg trap for the bears? In other words, are we going to sell off and this be leg one, pull back leg two, and then we reverse up to here? No one knows yet. But if the bulls get a very strong bull bar this week, that would increase the probability. Increase the probability does not mean high probability. It just means the probability has gone up for the bulls. At the moment, I think the bears will get a second leg down. My concern for the bears is rally, pretty tight bull channel, two-legged pullback around 50%, testing this area, which I mentioned on the daily chart, the top of this trading range. So this is a logical area for support, but the downside is strong enough that the first reversal up will fail. Now, what are the chances that we get back up to the July high? I think we will get up to the July high. I think less likely we're going to break to the downside and undo all of this. But this whole thing is a trading range. And if there's one thing we can learn from today, today was a good reminder of trading range price action. So let's go to, and remember what I said, bear breakout, middle of the range. Let's look at today. I need to draw some lines because this day did not save over on my other computer. So the first thing I always draw, one of those things, if it's Monday or the start of the week, open of the week is always an easy one to draw. So OOW, open of the week, is also the open of the day. So here's the open of the day. Next thing I'll go ahead and draw yesterday's low. And if yesterday's high, yesterday being Friday, whenever I refer to yesterday, I'm always referring to the prior trading day. And for these reviews, it's always going to be the ES.D. So it's always going to be the actual stock market prior business day. So here we go. And as you can see, one of the things I'll do, obviously I could draw yesterday's high or Friday's high all the way up here. But a lot of times, if there's something that's important, I'll mark it just as an easy reminder that, hey, this is a major lower high. And so it might be a magnet. But you can see what today was filled with really strong moves. Strong rally, but then completely reversed. Strong rally, but then completely reversed. Now, why do these moves happen? Why do you get these strong bull rallies that are one bar that melt away? Strong 3 bars, and then they melt away. But here, strong bear bars, and it's still got a second leg down. Part of the reason is this strong buying right here is just a buy climax. It's a buy vacuum test of resistance. This strong rally to 23 is a buy vacuum test of resistance. And because of that, when it reaches the magnet, same thing with bar 7. It's a buy vacuum. It's testing resistance. It's a big bar without follow through. And when that happens, there's a greater risk of a possible pullback or reversal. In other words, a second leg trap. But we'll talk more about that. Bar 1, first bar of the day. Small gap down, big reversal bar. Okay, swing by above the bar, taking a chance that we rally. But in general, 80% chance bar 1 is the low or the high of the, 80% chance that the week, let me back up. 80% chance that today or any open is going to form a trading range, which means there's only a 20% chance that you're going to get a trend from the open. So if you buy above bar 1, more likely it's a minor reversal. And then bar 2, we have a decent entry bar, but look where you are. Middle of a trading range, possible buy vacuum, test of 81. Bar 4, a bear bar, high 1 buy, an inside bar, so a contracting bar. Whenever you get an inside bar, the market is not breaking out of anything. Therefore, the market has to be contracting on a smaller time frame. You can think of it as a tight trading range on a smaller time frame, or you can think about it as a triangle. High 1 buy above 3. There might be buyers above, but whenever you're in a tight trading range and you're in the middle of the range, it's usually a good idea to expect disappointment. And then you could see bar 4 breaking below 3, testing far down to yesterday's 78 low. Bar 4, a little bit of a surprise, may go a little bit lower. But when you look at bar 4, is bar 4 the start of a trading range or the start of a bear trend? Obviously, it's the start of a trading range. And whenever it's the start of a trading range, it's a good idea to assume that we may go a little bit lower, but we're probably not going to form a bear trend. In other words, it's not going to form this most likely. So what's it going to form? Probably something like this. And that's why bar 5 looks the way it does. 5, it broke below 1 and then immediately reversed up. So some traders, they bought the 3 low, they bought the 2 close, they bought the 1 high, and they bought more below 1. And that's why 5 reversed up. 6, inside bar, high 1 buy above, low 1 short below. For the bulls, you can call it a second entry buy. And for the bears, they can call it a breakout pullback short. But when you look at 6, in general, selling below low 1s, which all low 1s are breakout pullback shorts. And if you're selling below a low 1, you want to be selling a low 1 in a strong bear trend. So 42, that's a low 1. Strong bear trend, probably going lower. But if you're selling below bar like 6, bar 6 is a low 1 or a breakout pullback short in a trading range. And that's generally speaking, that's a bad idea to sell below. And there's probably more buyers below. 7, outside up, strong bull bar. Outside bars usually are trading range bars. And look at this bar. Strong bull bar, but it's only one bar. And look at that bar relative to all the bars to the left. Look at all the big trend bars in this environment, and look what they did. Very big bull bar led to a reversal. Big bull bar went a little bit higher, reversed. Big bear bar, sideways. Consecutive bear bars, sideways. Big bull bar, sideways for a bar or two. Really big bull bar. What do you think is going to happen? Well, if the bears start to get 2 or 3 consecutive bear bars or one big bear bar closing on its low, it's going to trap the bulls. And that's what happened on bar 8. 8, second entry short, failed breakout of the 3 high, double top for the bears. Okay, swing sell, betting on a test of the 1 low and a breakout below Friday's low. For the bulls, I think it's reasonable to get out below 8. Too much risk of a deep pullback or a reversal down. And 9, we have a really big bear bar. Consecutive bear bars, 8 and 9, probably going to lead to a small second leg down. But look where you are in the range. Is this the start of a clear bear trend? Or does this look more like a trading range or an expanding triangle? We went up on 2, down on 5. So the market went above 1 on 2, and then it went below 1 on 5, and then it went above 4 on 7, and now it's reversing down. So that's an expanding triangle, up, down. So it's possible we form a wedge and a double bottom with bar 61 on Friday. So as strong as 9 looks, and 9 will probably have a second leg down. But whenever you're in a trading range, it's usually a better idea if you're thinking about selling. If you're thinking about trading in the direction of the breakout, it's often a good idea to try and enter on a pullback. And then you can see what happened on 10. 9 was just a sell vacuum test at the open of the day and the bar 6 low. And then it quickly reversed up, testing the bar 8 low as well as the midpoint of bar 8. So the bulls who bought the 7 close and more lower probably were able to get out break even during 8. 8, strong enough bull bar that the bears who sold the close in 9 are disappointed and they'll probably look to buy any pullback. And that's what happened on 10. Bears sold the close in 9, disappointed. Most of them probably sold above 9 or at the 8 low, which is the breakout point for the bears selling below 8. So the bears sell the 9 close, they scale in. What do you think they're going to do? What do you think they're going to do after they see bar 10? They're probably going to buy back their shorts or reduce their position on a retest of the 9 low. And that's why 10 reversed up. There were bulls who bought as 10 started to reverse up. And then when it reversed down, they scaled in lower. So what are those bulls going to do on the reverse up with 10? You know, a lot of those bulls are going to be disappointed. Therefore, as strong as 11 looks, it's an inside bar closing on its high. It's forcing traders to buy high, and it might be a trap, trapping bulls into buying in the wrong direction. Another way to look at that would be the market sold off to 9 and it formed a two-legged pullback. We rallied on 10, sold off on 11, rallied during 11. If we sell off on 12, we can get a second leg down. And then 12, we went outside down. Strong enough surprise, may go a little bit lower, but outside bars, you know, one thing to write down and just memorize, outside bars equal trading range bars most of the time. Why most of the time? Because trading range environments are most of the time. So an outside bar is a trading range environment. The market's breaking above and below something or below and above something. So as strong as 12 looks, it's forcing traders to sell low in the range. And there might be more buyers below 12 than sellers. If you're a bull and you bought above 11 and you scaled in somewhere down here, you're probably going to use any bounce to get out break even. And some bulls might try and get out at the 11 high. 13, buyers below 12, and we reversed up on 13, but a weak buy signal bar, probably more sellers above 13. But you can see lots of tails below bar 1 and near the low of yesterday, which is Friday. Inside bar on 14, probably buyers below, probably sellers above. And then we broke to the new low on 15. Look at 15 though. Does 15 look like a strong bear breakout? Of course not. We broke below a lot of support and then we reversed up. And the bears, if you sold below Friday's 61, you did not make money. The market instead found buyers below 61. And all of those reasons increase the probability that the market's going to reverse up and go higher. 16, inside bar, probably buyers below. And right now, when you look at the market, looks like the market failed to break to the downside and is probably going to try and break out to the upside. Bulls, they're getting strong bull bars closing on their highs. Plus, we know on the daily chart that this is probably forming support at yesterday's low, which is last Friday's low. Bar 7, bad low 1 short, probably buyers below, and there were sellers above the 16 high. 18, double bottom with 15, another failed breakout below Friday's 61. Even though it's a bad buy signal bar for the bulls, the odds are we're probably going to start to go sideways to up soon. And then we got a strong bull bar on 19. 19, enough of a surprise, probably going to go at least a little bit higher. But the tail on 19 is a warning that something is not quite right. You can see what happened. The market tested the 11 high to the tick and sold off. The high of bar 11, 26 and a quarter. The high of 19, 26 and a quarter. And then we got bar 20. 20 inside bar, probably buyers below and more sideways. So for the bulls, they see bar 20 as a pullback. We rallied up to the 19 high, sold off, and the bulls won a second leg up. The bears, they see another lower high. We have a high right here or a lower high compared to last Friday. And then another lower high on bar 12, another lower high on bar 19. The bears want a downside breakout and a measured move of this entire range. 21, a bull bar closing on its high. For the bulls, they see a high one buy above 20, but now that 21 is a bull bar and we've tried to bottom several times, I think there might be more buyers above 21 than sellers. And then 22, another bull bar. Tight bull channel, not a strong breakout. Are we always in long? In general, for the market to be always in long, you want 2 or 3 consecutive closes above the moving average. So if I had to pick a direction, we probably are always in long. But the only challenge here is if you're buying here, you're buying high in a trading range. And if you get a bear bar closing on its low, a lot of traders might look to get out. And then 23, very strong bull bar. But look at the breakout. 21, completely overlapping. 20, 22, big bull bar with the tail. And then 23, a really big bull bar. Always in long, but let's see the follow through on 23. Because we're in a trading range, 23 might convince a lot of bulls to start taking partial profits. And some traders will see this as a high one buy above this swing point. In other words, they'll see it as a pullback and they'll sell above. 24 inside bar, so a loss of momentum for the bulls. And that's a warning that something's not quite right. Always in long, but if we get a downside breakout, a lot of traders will be quick to exit. 25 outside bar, probably buyers below in a second leg up. But because you're in a trading range, this could be a double top or a failed breakout of the last Friday's 76 high, or you can call it an expanding triangle. Remember, expanding triangles never look perfect, but what matters is the logic behind an expanding triangle. Patterns are not always going to be ideal, but the market rallied, went to a new low of the day, went to a new high of the day, new low of the day, new high of the day. And because of that, this is a lot of trading range price action. You have to be open to the possibility that we sell off back to the middle of the range, and lower probability we break below the 15 low. 25, strong enough pullback, probably more of a trading range than a strong bull trend. And because of that, you don't know where the bottom would be. The bottom might be the 18 low or the 15 low. But in any regard, 25 is strong enough that we'll probably go at least a little bit lower. So I suspect a lot of bulls will either exit on the 25 close or exit on any pullback. And that will limit the upside for at least a couple of legs. 27, strong give up bar, consecutive bear bars, always in short, good for the bears. Completely undoing the rally up to bar 23. As strong as 26 and 27 look, the odds are we'll probably get a new low of the day, but look at the price action we've had overall with today. Because the price action is in a trading range, you have to assume that the bears will become disappointed. 26 and 27 is a major surprise. So major surprises, they typically lead to measured moves down. So it's possible we go all the way down here. 28, another bear bar, still sell to close. And what about 29? Is 29 sell to close? We had a strong bear breakout, pause, and then a sell vacuum down here. Whenever that happens, you always have to wonder if 29, this big bear bar, is just a sell vacuum test of the bottom of the range. Just like the market rallied, and when it tested the top of the expanding triangle, it sold off. Well, we're near the bottom of the expanding triangle. So what do you think could happen here? We could easily go sideways and reverse. At the moment, I think we've seen the high of the day and the bears will get a second leg down. But because we're in a trading range, if the high, what you have to always be concerned about is this: top of the breakout, bottom of the breakout, 50% pullback. So we could easily rally near 50% before we get a second leg down. That's why I said earlier, a lot of times it's better to buy a pullback than buy closes of bull bars or sell closes of bear bars in a trading range. 30 bull bar, but a doji. For the bulls, it's a failed breakout of the 61 low last Friday. For the bears, it's a breakout pullback short. It's a retest of the 61 low. Always in short, yes, but I suspect the upside and the downside is probably limited. And the bears will probably get a second leg down. In other words, 30 will not be the low of the day. 31, a retest of the 30 low. Probably buyers not far below. 32, a downside breakout. So a second leg down for the bears. But again, there's probably buyers here scaling in lower. And because the bears know that, the bears selling here, what are they doing down here? They're probably buying back shorts. So I suspect that this might be a sell vacuum test of 4,300 more than the start of aggressive bears selling here, right here. So there's 4,300. 33, reversal up. I think it's okay for bears to exit above 33, but 33 is probably a minor reversal. And what that means is the upside's probably limited. And if it's a minor reversal, the odds are we'll enter a trading range and not a strong bull trend. 34 broke above 33, reversed down. Probably buyers below 33 for a second leg up, and that's what happened on 30. Buyers below 34 for a second leg up, and that's what happened on 35. 35, a retest of the 61 low from last Friday. It's also a high one buy, breakout, pullback, buy setup. So there might be more sellers above 34 than might be more sellers above 35 than buyers. The bulls really need to break above the 61 low and get a strong close up here before traders assume the market's clearly always in long. 36 outside down. For the bears, it's the second leg down, retest of the 32 low. Probably buyers below 36, but then you can see 37. 37 is disappointing. It's a bad high two buy. And because of that, we may go a little bit lower. And then 38 outside down again. So obviously a lot of trading range price action and overlapping bars. And then 39 bear bar closing when it's low. For the bears, they're trying to get a bear breakout of a bear flag. And next, the bears are hopeful that they'll get a measured move down. But this probably is more just a vacuum test of 4,300. 40 bear breakout below the bear flag and this area here. Possible measured move down from the high of 36 to the low of 32. But 40 is just one bar, and the bears really need follow through. And they don't get it. 41, 42 consecutive bull bars, probably buyers below 42. And then 43, a possible buy vacuum test of the 39 low. But with 3 consecutive bull bars, I suspect buyers below any of these bull bars for at least a second leg up. 34 broke below 33 and reversed up. But high one buy, there might be more sellers above 34 than buyers. And then you can see 45. 45 is a retest of the 41 close. And even though this looks like a leg in a trading range, whenever you get strong bear bars in a trend, and you can argue we've been in a bear trend since bar 25, usually the first reversal up is going to fail and lead to a trading range. And that's why traders are buying here. That's why 45 sold off, and traders will probably buy it. Bulls who bought above 42 or the 43 close, they'll buy more below 44 or the 41 low. And the bears who sold the 40 close, they will scale in above 42 and on the 43 close, or even the close of 44 and buy back shorts near the 45 low, which is the 40 close. 46 strong bull bar, second leg up. Is it always in long? I don't think so. Until the bulls get clearly above the moving average, this is still a trading range. 46 is enough of a surprise that there might be buyers on a pullback, but the reality is there's going to be bears selling above 46, betting on at least a scalp and more trading range price action. 47 follow through, good for the bulls, but why are we not breaking far above the moving average? And the reason for that is because the bulls are not strong enough. 48, three consecutive bull bars, but a tail on 46, tail on 47, tail on 48 lowers the probability of buying, increases the odds of a pullback. And that's why 49 pulled back the way it did. 49, second entry short, or a two-legged pullback. We went up on 43, down on 45, up on 48, and down on 49. But probably buyers below 49 scaling in lower. And then 50, we have a pause. So 49 sold off, 50 rallied, pulled back. There might be more buyers below 50 than sellers. 51, strong bull. 51, a bull bar, but failed to close far above 50 or below 48 or 49. Probably more of a leg in a trading range. You can see the market's testing these price levels up here. And then 52, a doji, so probably more sideways trading. 53, bull bar, closing above the bars to the left. Good for the bulls. But when you look at the rally that began on 46, this looks mostly like a leg in a trading range. And now we're testing the Friday's 61 low again. Until the bulls get a strong bull breakout with follow through, the chances are we're still in a trading range. 54, a bear bar, but tight bull channel ever since the 45 low, probably buyers below. 55, a weak follow through bar. So any of the bears that sold below 54, they'll be disappointed on 55. And that's why the market went up again on 56. For the bears, they'll see a wedge, 48, 53, 56. Double top with 36. We might get an upside breakout in a test of the open of the day, but the bulls have a lot to overcome after this big sell off. And then 57, strong enough bull, surprise, probably going at least a little bit higher. But whenever you see a big bull bar, especially in a trading range day, near an obvious magnet like the open of the day or the open of the week, range to OOW for open of the week, big bull bar, if the next bar is a bear bar, that could increase the risk of a second leg trap, trapping bulls into buying high. The bears are hopeful that the traders who bought up here and bought more above a bull bar, like right here, they're hopeful that this is going to allow those traders out. They buy, scale in, and they scalp out. And then you can see what happened on 58. 58, clearly 57 was just a buy vacuum test of the open of the day and this area right here. 58, strong reversal down. Okay, swing sell, but tight bull channel that will limit the downside. But for the always in bulls, I think they have to get out below 58. Too much risk of a sell off and a new low of the day or a test of 4,300. And certainly a test of the 55 low. 59, decent entry bar, tail below, but probably sellers above 59 and more sideways trading. And then 60, a big bear bar, a little bit of a surprise. Three consecutive barrel bars that will limit the first reversal up and that will limit the upside. And the first reversal up probably will fail. And then 61, a bull bar, inside bar, but probably sellers above. And then 62, outside down. Outside down typically is a trading range bar, so that will limit the downside. And look what happened here. We sold off on 32, reversed up, sold off on 42, reversed up. Now we're selling off again. And we keep failing to break below 4,300. 63, barrel bar, but weak, and then strong reversal up 64. But a strong reversal up within a strong bear breakout increases the odds that any reversal we get will lead to a trading range and not a strong bull reversal. We may test back to this area. It was reasonable to buy the 57 close. And whenever it's reasonable to buy the 57 close, whenever it's reasonable to buy a breakout, especially in a trading range, if you scale in lower, usually there's a 60% chance you can get out at your original entry and an 80% chance, 80% chance that you can avoid a loss. and exit break even at your on the entire trade. 65, low one short, probably buyers below, and 66, a second failed breakout of 4,300. We broke below it once, reversed up, broke below it again, reversed up. Okay, swing buy above 66, but a high one buy for the bears, and that might lead to sellers above. And that's why 67 went outside down. For the bears, it's two legs down, sold off on 66, pulled back 67, sold off to the low of 43. Double bottom with 43 and 67 might be more buyers down here than sellers, and it's a double bottom with 45 right here. So we have a double bottom and a double bottom with a larger double bottom, these lows and these lows. Strong reversal up on 69, but a big bull bar at the moving average. That increases the risk that there might be more sellers above than buyers. And then 69 broke above the bull bar and reversed down. Give me just one more moment. 69 is a pullback from the 68 rally. And you remember what I said earlier today? I mentioned how for the bulls, I mentioned how whenever you have a breakout in a trading range, usually you can enter on a pullback. So look at all these breakouts. Big bull bar 68 up to 69, deep pullback, bulls bought down here. 70, a retest of the 69 high. Probably going to go mostly sideways. We have an expanding triangle 60, 63, and 67, and then 62, 67, and 69. And then a strong bull bar on 70. What about buying the close of 70, betting on higher prices? It's the first big bar in all of this. And look at 57, first big bar in all of this. A good rule of thumb in trading ranges is look at the size of the bars. When you get a breakout, look to the left. And you can kind of you can visually do this. Big bull bar, compare it to everything over here. Obviously, not ideal and pretty weak. Big bull bar. Here's a big bull bar. This bar was about the same size as 57, and it led to a sell off. So these are all just buy vacuums. And it's possible that 71 is a buy vacuum as well. Because of the context, it's a bull breakout of a bear flag from 63 low to 69 high, increases the odds that the bulls will get a second leg up. In other words, it increases the chances that bulls who bought the 71 close here can scale in lower and scalp out. 72 bear bar, but there's probably more buyers below than sellers. And then you can see on bar 73, we have a bull bar. So the bulls who bought the 71 close bought more lower, scalped out on 73. 74 inside bar, probably going to go mostly sideways. I think the market's going to test the open of the week and the close of 57. It was reasonable to buy this close. So if you scale in lower, you're probably going to make money. 75 weak bear bar. For the bears, it's a possible wedge. 69, 70, 60, 71, and 73, probably buyers below. And then another outside bar on 76, and then 77 outside up. Strong bull bar, and we rallied for a couple of legs. But look what happened. We got all the way back up here. And I wouldn't be surprised in the Globex session if we do reach the close of 23, which is 34 and a half. Not many questions today, so I will go through and answer them. But feel free to ask questions if you have any. For always in, I thought it was reasonable to buy above 1, but if you do, this is pretty tough. Maybe you exit below 4, and then, this is just really a mess. If you exit below 4, maybe you buy again on the reversal up, but if you didn't buy again, it's really tough to buy this close. And I think it's really mostly a bad idea. If you did buy the close, you get out below this bar, some bears will sell. But if you sell, what do you do above 11? That's a pretty tough call. So if you sell below this bar, I thought that 8 and 9 was strong enough for a second leg. And because of that, I thought that 11 here is more of a trap, and it may lead to a second leg down. And then I think the Bears, they've got to get out a couple of points above any bar if they were lucky enough to hold short until this point. And then the Bulls, they'll start buying or they can buy above 21. But then they get out. Do they get out below 23? I don't know if they get out below 23. If they understood it was an expanding triangle, they would. Otherwise, they would get out maybe a point or two below 20. When I say 23, I really meant 25. They get out a point or two below 25. Always in short, probably on 26, 27. And where do the Bears get out? They can get out above 33, but then how do they get short again? Maybe they sell again below 39, but if they do, they probably buy back shorts after consecutive bull bars betting on a trading range, or they buy back shorts here. Do the Bulls buy on 46? I think it's okay to buy on 46, and they probably hold below the first reversal down here. And then I'd get out of shorts below 55 or 54. And then this is pretty tough. If you get a bar like 56, maybe you buy as the market's going up. But then if you were long up here, you've got to have a way to get out. And I would certainly get out of longs below 58 at the latest. And really, if you're buying up here, it's pretty dangerous. You're buying after a pretty strong sell off. So to me, this is more of a trading range environment and probably a 50% pullback from the sell off. So here's the high, here's the low, there's 50%. And then always in short, probably below 58 or 59 and 60. I think bears can get out above 64. And this is really, really tough. I think they have to get out above, probably above 68. And some bulls will buy. And then maybe you buy above 71. Or, at that point, if you missed it over here, I just let it go. If you're trading with stop entries, these days can be really, really tough. You know, a lot of times as the market's going up, by the time it's clearly always in long, the market is probably going to fail. By the time it's clearly always in short, the market's probably going to reverse up. For limit orders, obviously it was a limit order day for pretty much the entire day. Bears selling X number of points above one, bulls buying below three, buying the one low, bulls buying below six, bears selling and scaling in higher or selling at a new high, bulls buying X number of points below bar 8, buying at the 6 low, selling above bar 9, bulls buying below any of these lows, bulls buying the 12 close, scaling in, scalping out, bulls buying below 14, bears and bulls fading bar 16, bulls buying below 17, and then where else? I thought probably sellers above these bars, but because of the size of 33, we may get a small second leg up, which meant there were sellers above 35. And then probably buyers below 43, 44, buyers below 48, buyers below 53 for a second leg, and buyers down here. And then maybe buyers below 75, but I would let it go. Buy the close, sell the close. I thought it was clearly buy the close. Maybe 23, but kind of dangerous. If you buy 23 and you see 24, you get out 25. If you're really protective, sell the close, probably 26, 27, 28. And you can even sell the close 29. Was it buy the close 57? I don't think so. But if you did, I would get out certainly below the bar. It's a failed breakout of a channel right here. And it's basically a wedge, 43, 48, or basically 1, 2, this area, and then 3. I don't want to remove that. And then maybe buy the close 71, but not clear. If you buy and scale in, you probably get out, or maybe you get out apart and you hold. Let me take a look at some questions. Brad, what's the difference between a spike and climactic? Yeah, what's the difference between a spike and a climax, or a spike and buy and sell vacuum? Well, everything is a buy and sell vacuum. We just don't see it always. So when you see a strong rally like right here, you know it's a buy vacuum. And at some point right here, the market's rallying. Let's use the daily chart. Let's look at an extreme example. So we have a daily chart, big bear bar, follow through bar. Obviously, it's a bear breakout and it's climactic. And when you look at that, you look at it and you say, yeah, okay, we don't know. We could just plunge down to 4,000. It's possible. Probably won't, but we could. And then we start selling off. We start hesitating. And then look, we test 4,300, 2,200 day moving average, and we reverse up a little bit and we start to go sideways. Here, the market's starting to rally, hesitate. And eventually, you get a gap up and it sells off. We have a sell off and then a plunge. A lot of times when the market's in a trading range near support, you get vacuums of that support. So we're channeling down, and then you see this strong sign of strength. That's a sell vacuum. Here we rally, pull back, we get a big bull bar. But look to the left, big bull bar, consecutive dojis, testing up here, and then it sold off. So I hope I'm being clear. To me, as far as buy vacuums and sell vacuums, to me, this is a classic buy vacuum. Strong rally to the open of the week. And you look at it and you think, oh my gosh, I've got to get long. It wasn't clearly always in long here. Now it's clearly going higher. And whenever I look at that, a bar like 57, and it's in the middle of a trading range, I always try and ask myself, hey, wait a minute, something just doesn't seem right here. Why are you getting a sign of strength right at resistance, the open of the week, middle of the day? Why did we not get a strong breakout down here? All breakouts are buy and sell climaxes. You can see all this saved, but this is a strong breakout. We have a channel, sell vacuum, sideways, and a strong reversal, strong follow through. Obviously going higher. Here, we just have one strong reversal bar after a strong sell off. So this might just be a pullback based on the 25 through 32 sell off. Okay, question. I just finished the section on major trend reversals in the video course. I bought above bar 64 here. I think that's okay. Now, one of my problems with buying above 64 is you're buying after a pretty tight bear channel. It's a second entry buy, but is this enough to undo this sell off right here? Look at bar 57. 57 is kind of one of those gotcha bars. And it's the same with 23. 23, strong rally, probably buyers below in a second leg. But instead, we got this, a strong sell off. This trapped all the bulls who bought here. Now look right here. Strong bull bar, probably buyers below in a second leg up. And instead that happened. And then this happened. So all the bulls who bought the 57 close and more lower are trapped holding a losing position. And because of that, that might lead to more sideways trading than a strong reversal. But anyways, back to your question. I bought above 64 with a stop below 63. I think that's okay. Targeting twice my risk. And I scratched, which means got out break even on 66 right here. If my stop was below 41, I held, I would have gotten 2 times risk on 75. Did I manage that correctly? Yeah, this is really common in a trading range. Trading ranges are notorious for falling below one layer of support and not the next layer. Kind of like right here. It goes above, this is a bad example, but it goes above the 7 high on 23, but it stays under this high last Friday's 77 and turns down. It breaks below bar 45 during 63. but holds above the 41 low. For me, I think what you did is okay. When you look at this, and if you buy above 64, my problem with buying above 64 is it's really buying above a bear bar in a tight bear channel. And then 65 is not ideal follow through. And then 66, pretty deep pullback. So it's reasonable to assume strong sell off, breakout, pullback. This might lead to a second entry short. So let's look at a 10-minute chart of where you bought. There's a 10-minute chart right here. Looks like a great buy. If I say that, that's not even the right bar. That is the right bar. So it looks like a good buy, but it's possible this is a sell off and a pullback. And then look what happens. So for me, whenever I'm buying, I think it's usually better whenever you have a bear trend. So you saw this, you saw the trend line break up to 57, and your thought was, I'll buy the retest, and you bought the retest. But when the retest is a pretty strong sell off, to me, that lowers the probability and increases the probability of more sideways trading. Someone mentioned the text was hiding the chart. I do appreciate that. What I was saying is this person bought above this bar and they ended up getting out break even up here. But they said if they would have put their stop below 42 and held, they would have made money. They could have gotten twice the risk. And that's true. But my only problem with buying above 64 is buying when 64 is buying in a pretty tight sell off down. So you had a sell off, trend line break, and a retest, major trend reversal. But when the sell off, in other words, the retest to the double bottom or the original low here, the sell off on 58, 59, and 60 was strong enough to lead to lower prices. So I think it's better to wait for a trend line break of this. So wait for something strong to break this trend line and then get a double bottom. Was the sell below 49 reasonable? 49, my only problem with selling 49, I get the logic. It's a double top with 36 and 49, and it's two legs up, leg one, pull back, leg two. My only problem with selling below 49 is you have three consecutive bull bars, 41, 42, 43, and then three more bull bars, 46, 47, 48. So on a higher time frame, the market is forming a strong breakout. So this two-legged move is one big bull bar on a higher time frame. Plus, you had so much buying pressure today that the odds are there's probably buyers below scaling in lower. I don't have a problem with bulls getting out below 49, and I think some bulls will. My only issue here, though, is if I'm selling below 49, I want the follow through to be really strong, really quick. I want the market to reverse quickly because if it doesn't, that means I'm probably on the wrong side. And then look at 50. 50 weak bear bar increases the risk of more sideways. And in hindsight, it was just a retest of 45 high or the 44 high. What about the sell below 76? To me, 76 is there's two problems with 76. 76 is late in the day, so time is against you. If you're selling below 76, you have to ask what your goal is. Low probability that the market just plunges down to a new low in only a few bars when there's only a few bars left in the day. And you have magnets above open of the week and this close. It was reasonable to buy 57. And the bulls who bought the 57 close never had a chance to get out break even. They buy the 57 close, big bear bar. They never had a chance to get out break even. And this happens often enough where the market allows those bulls out in the last minute of the day. Obviously, here it was bar 77, and there were still quite a few minutes left. Okay, question about taking partial profits. I understand Al's explanation about reducing risk when stop becomes too far away, but shouldn't a trader's IQ, trader's equation, EQ, at any point give only a binary in and out suggestion? Yeah. So let me reread your question. So your question is basically about reducing risk and stop loss when it becomes far away. But shouldn't a trader's equation at any point give only a binary in and out suggestion? Not really. There's several factors. The problem with let's just take the obvious. Let's say you're a hedge fund and let's use an extreme example. Not what I'm looking for. Give me 1 second. Anyways, let's go to a monthly chart. Say you're a hedge fund and you bought during COVID, okay? And you're buying and you're holding long all the way up here. Eventually, your risk will become really, really big. And if you're a hedge fund, you have certain parameters, or if you're any fund, there's certain rules, there's certain requirements, there's certain percentages you have to be allocated towards. And at some point, that percentage gets far too big and they have to reduce the risk. And there's a couple of other reasons. Well, but let's go back to that. If you know that institutions are going to start, they're going to start lightening their position or reallocating their position. They might, for funds, they might start going more and more in cash. So as this is going up, Vanguard or any of those major funds, they might start increasing their cash position. So maybe they start going 30 to 40 to 50% cash. Who knows? But the point is, they're going to start reducing their position. Then, when the market starts to go down, they start increasing the amount of equities they have. So their cash reserves goes down and they have a higher percentage in stocks and more in cash or less in cash. So, how is that relevant to a 5 minute chart? Most traders understand that the market is in a trading range most of the time. Most of the time, the market's doing this right here. Very briefly, is it doing this? And because of that, a lot of traders, they start selling and they'll sell aggressively on the way down. But then when the market hesitates, they start to reduce their position because they know that sideways goes most of the time the market goes sideways. And sometimes the market does this. Just look at this entire day and buy every strong bull bar and ask yourself, could you scale in? By the second close, I could have scaled in. I bought this close, I could have scaled in. I buy this bar, not ideal. If I bought here, the market reversed. Bought this close, I could have bought in lower. If I bought all the way up, it quickly reversed. I know I'm not answering your question, but the point is this. You have to have a way to reduce your risk. And if you think about the trader's equation, what it really comes down to is other people's money, that concept. Whatever's in your account is your money. So if you sold below 25 and you got out, if you sold below 25 and now the market's down here, your open risk is the 25 low down here. But the reality is that's your risk. Your risk is how much exposure you have to the market at any given time. So risk to me is the market price to your stop, not where you got in to your stop. So at some point, if you're short down here, no one's going to be short down here with the stop all the way up here because they know the risk reward's terrible. Who would sell the close of this bar and put a stop all the way up here? It just doesn't make any sense because that is 1 times your risk. So what do traders do? They naturally start lightening their position. And there's 2 ways you can lighten your position. One, you can reduce your position. You can exit your trade or exit part of your trade, or you can use a tighter stop. And maybe you put a stop up here. So, anyways, I don't know if I'm answering your question, but if I'm not, just ask it again. Ask it again, and I'll talk more about it. Okay, so it looks like that's it for questions today. Tomorrow, what do I think is going to happen? Well, let's go back to the daily chart. We have a reversal up, another failed breakout below the 200-day moving average, but we have a big sell off from the high of last Friday to the low of today. So this might be a pullback. since we're in a trading range, I wouldn't be surprised if tomorrow is a bull bar and traps the bears. The bears, they want to prevent the bulls from getting a strong entry bar. The bulls see a double bottom. They want a strong entry bar and reversal up to the August 18th low. The bears obviously want to prevent that. All right. Thanks everybody for watching, and I hope everyone has a good rest of their day.